Right, welcome back. You're watching Stock Watch with me, Nolutando Mlambo, and joining me to take your stock-related questions tonight are Wayne McCurrie from F&B Wealth and Investments and David Shapiro from Sasfin Securities. We are pre-recording today's episode, but do continue to send through your questions on email at stockwatch@bdtv.co.za, via SMS on 41392 or on X using the hashtag StockWatch. Gentlemen, good evening and thank you for your time today.
Hello, yes.
Hi, guys. Yes. Hi, David.
Yes.
Hello.
Thank you so much
It's
for being with us
lunchtime.
today.
We're hungry.
Well, we've got lots to get through today. We have interesting questions. Some I understand, some I don't. So I'm glad we've got some experts in the room. We'll start off with Theo's question. Theo says, since the disaster of COVID-19, which played havoc with my Tiki Line portfolio, Pick n Pay, Old Mutual, Nedbank, Quilter, the only ones recovered above pre-COVID-19 are Nedbank and Quilter. I want to get rid of Pick n Pay and Old Mutual and reinvest in ArcelorMittal as a long-term investment. Any thoughts? David, we'll start with you.
Yeah, he needs to have a cold shower. I think to go into ArcelorMittal is it's a very difficult decision. It's extremely cheap, but there's a reason it's cheap. You know, they're battling in the steel industry, and for many reasons. And I think a lot has to do with underlying demand. And issues here, you know, if you go through ArcelorMittal's account, they have problems even with transport, even a company like ArcelorMittal, where, you know, all the other areas of factors of transport have been taken up. So I think, you know, they can't get lorries. They've always got issues. So I think just give it a bit of chance, you know, give it a bit of time to pick up. I wouldn't do the switch yet. I'll let Wayne continue with answering the rest of the question about the Tiki Line issues.
Yeah, Wayne, what are your thoughts?
I get the Tiki Line story now. It's actually penny stocks.
Okay.
Penny stocks.
Yeah.
I think that's what Tiki Line means, but that doesn't matter. I mean, just first of all, Pick n Pay hasn't really got much to do with not recovering from COVID. Pick n Pay is not recovered from itself yet. You know, there's tremendous upside in Pick n Pay if Sean Summers can get it right, but it is such a hill to climb. So, I mean, you could make a fantastic return out of Pick n Pay. The share could also do nothing for a very long time. Personally, it's a mammoth task. I wouldn't own Pick n Pay right now. Maybe if he does get it right, maybe let the first 50% of the share price rise go to someone else, and then once it's established on the right road, then maybe reconsider investing into it. But to buy ArcelorMittal, I mean, everything David said is correct, but the true real underlying problem is that ArcelorMittal, the old ISCOR, was established in the apartheid years because South Africa needed to produce steel in case of sanctions. Same as we needed to get petrol, that's why we got SASOL because of sanctions. Same as we had an arms industry, Denel, all of those companies was because of international sanctions and the fear of the apartheid government that they would not be able to survive as a country without all of these industries. So the real problem with ISCOR, ArcelorMittal, is that it's actually too small to compete with the global players. When you look at the global steel industry, there's overcapacity, and the other players produce, I don't know, 20 times the volume that ArcelorMittal does, and they can just cut the price out from underneath you. You cannot produce steel at a competitive price. So I know they got some advantage because of transport, because you got to get the steel from China to here, and I know they got some advantages because of tariff protections, but it's really not. In other words, ArcelorMittal, in theory, shouldn't actually even be here. It's not a viable economic entity.
Very interesting indeed. I think that one. I also want to ask them about Old Mutual because that's part of this one. Old Mutual's at an exciting place, I guess. The bank is going to merge. And what do we make of that stock? Is this one that you would hold on to? What's the story with that one, Wayne?
Yeah, look, I've worked in the life insurance banking industry my whole life. And you know, David's also been in the financial services the whole life. And there's a couple of factors here. it's intensely competitive. There is intense competition. So maybe a smaller company like Momentum can, be a little bit different. But the big gorillas, there's actually not much they can do to truly change their fortunes all that much. And as I said, it's highly competitive. This Old Mutual does look very, very cheap. So I think it's a good share to own because you're going to get a dividend there. I don't think there's much risk involved in the share, but it's never going to shoot the lights out. Old Mutual Bank, by the way, it's not the first time they tried this. They tried this, David, 20 years ago. An Old Mutual Bank in collaboration with Nedbank, it didn't work. Now, if you want to talk about a competitive environment, the banking environment's more competitive than the life insurance environment. And there are so many new players in there. Bank Zero, there's a lot of new people coming in. Every company just about that I come across is opening up financial services in some format. All the grocers are doing it. All the cell phone companies are doing it. This is a highly competitive market. Ask Discovery how successful their bank has been and how much money it's cost them. I don't think Old Mutual Bank's going to change the course, the direction for Old Mutual at all. But I still like the share. I still think it's fairly valued, but I don't think it's going to shoot the lights out.
David, any thoughts on this one before we move? Yeah.
There's a lot in what Wayne says, and I think the fact that you've got financial services companies desperately trying to seek out other avenues of revenue just shows how tight and competitive things are in the market. And Lula, you must remember the other thing is that the economy is still not growing. Yeah. We're still at less than 1% or 1%. That's hardly growth. And these industries only flourish when people are flush with cash and want to buy investment products or believe that they've got to take out insurance and so on. So there's some time. But I must say one thing is that markets are on the move at the moment globally. And what happens in a situation like that is that it's, rising tide lifts all ships. So they get lifted for other reasons, just a sentiment drive as well. If you want to see, like you got results like Absys, which were rather poor, and yet the shares gone up, and shares are going up. Simply, there's a very positive, positive sentiment in global markets, driven by the view that rates are going to come down.
Thank you for that one. I think very comprehensive, and I hope that gets our viewer going and lots of clarity for him. I want to move on to a question about Ascendas Health. This is a very interesting business. The viewer says, I've been looking at Ascendas Health for some time, and the share price is not having any considerable upward movement. Do you have any idea as to the direction of the company and the subsequent effect on its share price? David, I think you've got quite a bit to say.
We have been asked questions on Ascendas as long as we've been on air, which I don't know how many years it is. And every time it comes to, I don't know anything about the company. I really can't add any value to Ascendas. I don't know. This just seems to be one of these businesses where it seems to attract the extreme punters, everybody who's looking to make some quick profit. But I have no idea. I can't really give you any good answer to that. I don't know if Wayne can. But
Wayne, yeah. Sure.
I was hoping David would give a decent answer on that. Look, I do know, there's been some controversy, some issues in the past with Ascendas. I don't think materially, but I'm not keen on the healthcare industry at all. The government, and not just our government, governments worldwide have got the healthcare industry in their crosshairs. They're trying to squeeze margin out. We've got this, you can just see it with single exit pricing. And, I don't know how long it's going to take or what's going to happen, but governments worldwide want to squeeze profits out of the medical industry to get cheaper services. So it's one part of the market I really don't like. And if I was forced to buy shares in that, I'd go for life healthcare. I know Ascendas is vastly different, but certainly to me, life healthcare represents a better buying opportunity.
At one stage of its life, I think Ascendas was 28 Rand a share, or 2,800. I think it's what, 70 now or something, and that's been trotting along that path. I don't know for how many years. It has a market value of 400 odd million. It's hardly the kind of share that, you can look at it in depth. And it just seems to be one that always attracts someone's attention. So
Very interesting indeed. We have very little time for now. I want to ask one question on Blue Label that came across.
Yeah.
Is Blue Label Telecoms a good investment? That's a good question. It's a bit of an opaque one for me.
Yeah.
I'm keen to get your thoughts on that one. Wayne, is that a yes?
Man, Blue Label is very interesting. David knows way more about it than what I do. But the old Blue Label business was a good business. It was a good business. And I know it's vast oversimplification. They bought bundles of airtime and split it and sold it. And the two brothers did a fantastic job there. But then they decided, and they had very logical reasons at the time, to buy Cell C. And this has just drained the kitty and continues to drain the kitty. These small players cannot make money in this environment. The regulator's pushing down the cost. We're using more and more data, but the cost of the data is going down, so your revenue is stagnant. I mean, I think if you had a spare 2 years and you were a chartered accountant, or in 2 years' time, you might be able to understand the financial structure of Cell C and all the loans they got and what they guaranteed and what they haven't guaranteed, et cetera, et cetera. But having said that, the results today were good, eh?
Wait, please come in on this one.
I don't quite understand the results. That's the problem, is that there's a lot of adjustments that you have to bring in. But as Wayne said, they wrote off 5 billion Rand, I think, in the purchase of Cell C. First time around, they've recapitalized it. The other thing, without attacking them in any way at all, because I really wish them good luck, and they did start a very good business. The problem is that this is not an area you want to get involved in. Cell phones, whatever it is, we've seen through MTN, the issues that they've gone through. We see it with Vodacom. Everybody wants to buy their product for nothing. No, in other words, no one wants to pay for data or anything that they use. And globally, those prices are going down. And against that, there are massive costs of putting up towers, going from 4G to 5G to 6G. And even though they don't own anything and they rent it from other operators, they eventually have to pay. They're not going to get that for free. So it's not the kind of business that I exposed to. I know, and going back to the first question, everybody says, okay, we're going to get into fintech. We've got all these customers. Let's start selling them other products. It's not that easy. Yeah. So by choice, I just avoid that industry, whether it's Vodacom, MTN, Cell C, Telkom, you name it.
Got you, David. Gents, we have quite a few questions to still get through. I want to start with a cybersecurity question here. It says, Palo Alto seems to have delivered strong numbers. CrowdStrike used to be my favorite cybersecurity stock until the recent outbreak, I guess the outage. Is Palo the better stock? Has it run too hard? David, let's talk about that one.
It hasn't really run too hard. I think it had a bit of a torrid time. It was actually marked down after their previous results and seems to be coming back. It is, at this stage, the better one. Everybody liked CrowdStrike until they brought down the whole of Microsoft. Everybody who used Microsoft around the world, people couldn't fly. The damage was intense, and it takes a long time to get your reputation back. So, even on that basis, just stay with Palo Alto. It is a good business. It has its issues. These are smaller businesses at the moment, so it takes them time also. And cybersecurity, to get the businesses right. And cybersecurity, well, that's a seriously difficult industry to play in. But they're, for choice, they're okay. I certainly prefer them at this stage. Take them in small bites. You know what I mean? Don't take big bites of these.
Yeah. Slow and steady wins the race there, David. Wayne, I want to bring you on a SASOL question. SASOL came up with numbers yesterday, says, can the panel let us know if SASOL has not bottomed out and can only go up from here? I also see a strong rand not being good for SASOL. Which other counters would benefit from a stronger rand? So I think those are two questions, and I think we can take them in separate parts. Please go ahead, Wayne.
Okay, look, I think SASOL has bottomed out, but if the oil price falls to 70 or global chemical prices carry on falling, then it hasn't bottomed out. So I don't know if it's bottomed out or not. I mean, it's fallen from 400 rand to the current levels. What's it, 120, 130 sort of range. If we get a global economic recovery and interest rates fall and things look a bit better, then SASOL can double easily. But it could also halve if that's not the way it does work out. Just on the strengthening rand, you must remember there's two sides to that coin. A strengthening rand normally implies that the global economy is going to recover or going to do better on the back of lower interest rates, which means commodity prices are going up. So in other words, the commodity shares outperforming like SASOL normally coincides with a strong rand, just that the price of commodities go up much more. And of course, all of these companies are geared to that commodity price than what the negative of the strengthening rand affects you. So surprising enough, if you own commodity shares, you actually want a strong rand, because generally a rand only strengthens in a commodity upcycle or in anticipation of a commodity upcycle, which I think is happening now. I mean, the last 6 months, the rand's gone from 1920 to 1770, 1780. So it's actually good news for companies.
Okay.
And all the mining companies are in the same boat, except for gold. All the mining companies are they're in the same boat.
SASOL's issues are on the chemical side.
Yeah.
If you looked at the energy side, it's okay. That was their gas, fuels, and mining. But chemicals is a disaster, and there you're fighting the Chinese, or you're battling against the Chinese. And Wayne mentioned earlier on about the about ArcelorMittal and the power to produce the sheer size. And you're taking on the Chinese in terms of the product that they produce. So, if you looked at the headlines today or listened to management yesterday, they're looking to get rid of non-performing assets, which I would assume are on the chemical side. And that's where you've got to wait for those prices, which will come when demand starts to pick up. So if you look at the chart, it's, you can see the signs of bottoming. You can see that even against this news, I know it was down yesterday, it's up today, are going flat. So you probably, we're going to reach that bottom if we're not there very soon. So the upside is a lot better, but you've got to be patient with us. You can't force it.
I just want to stay with SASOL a little bit because we've also seen a bit of a management rejig. I think new CEO, new CFO coming to the fore here, but also lots of pressure on them going green. I'm wondering if that could also play into the share price at all, David. Those operations still terrible emitters around the world.
Well, if you heard Wayne earlier on, SASOL was built for one reason only, and that was to avoid or to counteract sanctions during the apartheid era. So, it's not the most progressive way of producing oil or other things. It was done for a reason, and I think that acts against them. They can't, in Secunda as well, the whole way that it's set up, you can't take coal and turn it into oil or something like this and not emit foul fuels or something, foul air or something. So if they can't do it, if they do it, whatever they have to do, it'd be at an enormous expense. So it still kind of hangs over them. So and it goes back to historical reasons.
Thank you for that one. Very interesting stock indeed there. Let's talk about City Lodge. We've got a question here. City Lodge Hotel has had a small rally. It is still significantly below 2-year highs. Why is it below recent highs when most info, both macro and micro, has been positive? Any one of you would like to take the City Lodge one?
Yeah, no, I can talk about City Lodge. I actually like City Lodge a lot. I think it's a great company. Whenever I travel around the country, aeroplanes are full. The last City Lodge results that came out, I mean, they can still obviously take more people in, but the average occupancy rate was up quite nicely. you're going to have some economic growth here. I mean, even with the slightly stronger rand, this is a great place for people to come and visit. So I think that City Lodge is actually quite cheap, and I like it.
Right. David, nothing on City Lodge from your side?
No, it's always been a well-run company. It suffered because of COVID, but I think it's overcome that, and it's back to very decent occupancy rates in there. So it's a good operation. It's not seaside, it's got no casinos, but from a business point of view, still a very good operation.
Talking about one of my favorite counters up next, can I still buy Spur? Have I missed out on the easy money? I love Spur as a business. It's just such a good business. But I'm keen to get your thoughts on that one, David.
Wayne is the expert
on Spur. Go ahead, Wayne.
He knows the menus backwards. But I just want to say, I'm going to hand over to Wayne though, but I want to say, when I say unfortunately, I travel a lot to see grandchildren all over the world. And I want to tell you, the value that you get at Spur is unbeatable around the world, where you can pay whatever it is, 100 odd rand for a steak and chips and whatever you get. There's nowhere in the world that you will get that kind of quality, no matter where you are. So I still think it's a really good business.
Yeah. Wayne?
Go, Wayne. You know more about the actual financials than I do.
No, I agree with David. I mean, I love Spur. I think it's good. Their onion rings are just the best onion rings you could possibly eat.
I agree.
They are the best. When you look at their results that came out, I mean, they're also struggling in, not dissimilar to the banks, by the way, and the life assurers. This is an intensely competitive market, and they're still struggling a little bit with, the consumers obviously not cash flush. Their signature brands are doing very, very well. I like the company, but once again, I don't think there's any problem if you want to own a share, but I don't think it's going to shoot the lights out. The environment's just too competitive. I mean, it's a strong, strong player in its field, so I don't think there's a hell of a lot of risk there. But, I just can't see it shooting the lights out, as I said. I like the company, and maybe you should own the shares because I think it's a nice compounder, and I think, extremely good management. Yeah.
Brilliant. So I want to also...
There's something that we have to bring up as well, I think, especially for companies. First of all, you've got food inflation as well. So the costs, and they can't necessarily pass it on to the consumer. The other is high interest rates. Most businesses fund themselves, haven't got that much cash. They're always using a bit of borrowings and that. And where you've got the overdraft rate now at 11 1/4, 11 3/4, I'm not sure where it is exactly. It's very difficult to make the margin. So going back to what Wayne says, while they make good steaks and good onion rings of that, from a business point of view, it's difficult. There are pressures on them.
Hopefully we'll see those wearing off a little bit in the next few months, David. Let's talk about Avenge. Yesterday they were out with news about a split. Viewer asking here, should I sell it? And I guess that's a good question. On the back of these news, is it a time to exit Avenge as a business? Any takers?
Look, I think if you got Avenge, don't sell it now.
Okay.
There may be some value unlocked in the splitting between, McDonald and
Moolmans.
Yeah. They're splitting it off. So I think there's some value there, but, this company's got bad history. They've done terribly badly in the past. But if you own it, I wouldn't sell it now. I would wait for that split.
Their construction businesses are now centered in Australia.
Yeah.
Australia,
so Moolmans, which is the kind of the mining company and that. So this used to be a significant player in the construction industry back in its heyday. I'm with Wayne at these levels. It's so cheap at these levels. Just wait and see what comes out of it.
Let's get into some stock picks now. Let's start with you, David. Which counter are you loving this afternoon?
Well, this is something I haven't done before, is pick a South African stock. But I'm big on this two-pot system.
Okay.
And I think that if I could find a stock, it would be Hollywood Bets, because I think as the money comes, having watched all the adverts in the Olympics during Channel 203, watching the football, just Hollywood Bets and booze and that. But I think I'm going for a retailer, for a apparel retailer. I think Mr. Price looks very attractive. So this is a punt. on the fact that this money is going to be released and people are going to rush and spend it fast, very, very fast. So don't ignore what this is going to do for the economy.
All right, and Wayne, your stock pick this afternoon?
You'll have to remind me. I've forgotten what my stock pick was. I think it was APSA, wasn't it?
Was it APSA? We'll ask the producers.
I think it was APSA. I can't remember. These days you can't remember things so well. But anyway, my stock pick is APSA, and they've got the change in management. This share, I know we spent half the program talking about intensely competitive financial services environment, but this share is truly, truly undervalued. It is just dirt cheap. And with the change in management, they've had as many changes in management as what Joburg's had mayors in the last couple of years. Just a few things have got to come right, and you can actually see the share price going up quite nicely. It's a little bit of an outside bet, so once again, don't put all of your retirement money into it. But I think it is just simply too cheap.
Well, gentlemen, we are out of time. A great time with you this afternoon. Thank you so much for joining us in Stock Picks. That's all for tonight's Stock Watch, rather. Thanks to our guests, Wayne McCurrie from FNB Wealth and Investments and David Shapiro from Sasfin Securities. Up next to the close. Stay tuned.